around the world, there are currencies failing or effectively failing all the time. I was in Egypt this summer. That's where I lived part of the
Awesome.
year each
Yeah.
year, and they were dealing with 40% inflation while I was there. Um, and they have structural, 20+% money supply growth year after year after year. And occasionally, when they break their kind of pseudo currency peg, a lot of inflation kind of comes out at once. Um, and that's not even the worst example. I mean, that's a currency that's not hyperinflated in the past 50 years. It's just it had this kind of constant higher grade inflation. There's a number of currencies that fail around the world, and then we're starting to see that in developed markets, their public debt has accumulated to a significant degree, especially in the United States. So, for years, for decades, debt accumulated on both the public sector and the private sector. Starting with the global financial crisis, some of that debt started to rotate from the private sector to the public sector, at least when it comes to a percentage of GDP. And so now the problem is that there's no longer an offset. So for decades, you had rising public debt to GDP, but falling interest rates, and
Mhm.
therefore interest expense was manageable. I think we're entering the phase where interest expense starts to become more of a structural issue because we're no longer structurally declining in interest rates. And that basically means that all developed countries, or most developed countries, basically start to encounter the situation that Japan's already been in for the last decade, with the main difference that they don't have some of the strengths that Japan has. They don't have, in many cases, they don't have Japan's current account surplus. They don't have the kind of the harmony of population that they have. Europe and North America are generally more polarized politically and socially than Japan. The US has structural trade deficits and current account deficits. And so when these countries kind of encounter the same situation that Japan's had, we probably should expect it to be more inflationary for them than it has been for Japan. And even Japan's future is probably more inflationary than we've come to expect over the past 10 years or so, because even in their case, we don't really see the private sector deleveraging anymore. So during the whole 2010s, while you did have large monetized fiscal deficits and you had a growing public debt balance, you did see deleveraging among the private sector, especially the corporations. And when you deleverage, when you retire bank loans, that actually destroys broad money. And so Japan had some of the slowest money supply growth over the past 20 years. But they kind of deleveraged their private sector as much as they're going to. And so going forward, they still have all those monetized fiscal deficits, but they're not going to have private sector deleveraging anymore. And they've come to realize that they have to increase their interest rates at least a little bit in order to create a positive interest rate. And so I think that both for Japan's case and the world, as we all kind of go through Japanification together, it's probably going to be more inflationary than we've come to expect. So the traditional portfolio, the 60/40 portfolio, the issue with that is that it's geared primarily towards disinflationary growth. So equities do really well when the economy is growing in a disinflationary manner, and bonds do pretty well when you have kind of a slower economy and again, disinflation. Historically, there are certain decades where both stocks and bonds do fairly bad. So the 1910s, the 1940s, the 1970s, the 2000s, those are environments that were generally more inflationary. And so owning, harder assets, owning, it could be commodity producers and energy producers. It could be hard monies, gold or Bitcoin or assets like that. And so I think that having that third slice in a portfolio is really important. It's not a crowded space like we mentioned before. The media is not really talking about it. Energy stocks had a good period in 2022, but then investors kind of moved on elsewhere. And so I think that basically having that three-pillar portfolio of the somewhat more traditional side, but then also making sure you have that harder asset, or those types of assets that benefit from decades of debasement or higher inflation or stagflation. I think that's how probably investors should consider positioning themselves. Yeah, I mean, it's already active in a number of countries, right? So there's already countries where a central bank digital currency is deployed. Generally speaking, they've had slow adoption. People don't particularly have an appetite for them. They're not really solving a problem for people. When we think of what makes it good money, there's, from one perspective, you look at the issuer. What does the issuer want? They want more control. They want more surveillance. What does the user want? They want the money to hold their value or appreciate. They'd like it to be easy to use and private. And that so for CDBCs, those really conflict. The issuer likes it, but not particularly the user. And so in countries that it's been deployed, it's generally been slow to adopt. It generally requires enticements to get people to use it, even temporarily. In the United States in particular, because our system's kind of at least a little bit decentralized, there's more kind of checks on power. The chance of getting one in the next few years, I think, is fairly low. I do think that a number of countries, or at least a number of politicians in a lot of countries, are going to keep trying to push forward the idea of a central bank digital currency. But I think that there's now enough public pushback against
Right.
it that there
Right.
are frictions against doing so, and I think that's a good thing. So I think that the world's in different parts. China's obviously been in slowing for quite a while. The rest of the world is not particularly hasn't been particularly doing very well, partially because the dollar's been strong and kind of weighing it down. The United States has been ahead of the pack, but that's largely because we're running some of the biggest fiscal deficits as a percentage of GDP, which has a stimulating effect, at least on certain parts of the economy. But I do think that we're finally seeing softening of the data. It's not necessarily a recession yet, although some of this data can get revised down later after the fact, and we could find out that we're in a recession. But generally speaking, we have a softening of the unemployment rate is gradually rising from a low level. Payrolls have been soft for a while, and then there's potentially inconsistencies in their data. And so I do think the U.S. is entering a softer period. One of the things I've been kind of highlighting is that recessions look different when you have fiscal dominance. And a similar way to think of it is that recessions in emerging markets look different than developed markets. They tend to be a little bit less explosively disinflationary, like we've come to expect in developed market recessions, and instead they tend to be more of a malaise. They tend to be more stagflationary. And I think that if we do get recessions like that in the developed world, given the sheer size of the fiscal deficits, that's probably what we should come to expect. And so I think that the structural components are still there going forward for inflation, for currency debasement, and that this is just an environment where you probably want to be diversified. You probably want to have some risk-off assets. There's different parts of it. Rate cuts should be moderately beneficial to them. Um, I've been in the camp that the health is not as bad as many people have feared, despite the fact that there were bank failures, and that's because if you go look how banks look going into the great financial crisis, they had cash and treasuries as a record small percent of their total assets. Instead, they were very much into lending to subprime borrowers and things like that. They had risky loans were a much bigger percentage of their assets, and those nominally risk-free assets were very low. In this environment, banks have some of the highest allocations to cash and treasuries as a percentage of their assets, compared to things that can, nominally default. Now, that obviously didn't protect some of the more leveraged ones that brought a lot of the long end of the curve, like a year and a half ago. But as long as banks avoid that mistake, I think that the probability of major bank failures is not as high as others expect. But they're basically becoming a vehicle for assisting U.S. deficits, basically that the kind of a structural financier of treasuries. They're probably going to face a higher period of credit losses in the next 12 months. But unlike the subprime mortgage crisis, a lot of the borrowers they have are a higher credit rating now. They've been relatively reticent to lend toward less credit-worthy borrowers. And so while we should probably expect some pockets of trouble in banks, especially certain regional banks that might be more exposed to commercial real estate, I don't really expect the type of disinflationary kind of bang that we've come to expect from banks like the 2008 period. And instead, I think that they're kind of part of this stagflationary mix that we're still kind of in. I mean, the fact that we have unemployment rising while the inflation rate is still roughly 3% officially measured. And we're running 6 or 7% of GDP fiscal deficits as far as the eye can see. This is an environment that is somewhat nominally supportive for
Well,
consumers or banks, even though on the real basis they can struggle.